Alright guys, so the carnage in the US economy isn't done just yet. Once again, the bond market just revealed big cracks that challenges everyone's assumptions. And because of that, the US Treasury Secretary Scott Bessent is in panic mode. He's proposing a plan to save the bond market without relying on foreigners. Needless to say, this should ring the alarm bells and sounds the hyperinflation alarm if it really comes true. Should all the bonds be bought domestically if the basket blows up? It would be the US economy that collapses, not the world. But it makes sense for the concern. We had the biggest rise in yields since 2001 on the 10-year. Massive liquidity concerns were bound because people were selling, but not many people were looking to buy. And as a result, the 30-year almost hit 5%, while the 10-year went well past 4.5%. The problem here is the uncertainty. Over the past few days, we have seen an insane amount of flip-flops. First was the exemption of electronics like smartphones. Then came Blutnick telling the world that those would be rolled back and everyone better brace for a semiconductor war in just 30 days. Is this crazy back and forth that's making everyone just flee from US assets? And now we have Ray Dalio telling us that the entire US system is on the brink. Trust in the existing financial architecture is under serious threat.
And I'm worried about something worse than a recession. We have something that's much more profound. We have a breaking down of the monetary order. We are going to change the monetary order because we cannot spend the amounts of money, so we have that problem. And when we talk about the dollar and we talk about tariffs, we have that. We are having profound changes. Such times are very much like the 1930s. I've studied history, and this repeats over and over again. So if you take tariffs, if you take debt, if you take the rising power challenging the existing power, if you take those factors and look at the factors, those changes in the orders, the systems, are very, very disruptive. How that's handled could produce something that is much worse than a recession.
As such, a sober person would realize the solution. You need to stop the tariff war and to bring back a semblance of sanity in the global trading order. Plus, you need to cut down the US deficit spending and de-escalate the situation with China. Because if you don't, this exodus of money from the US economy is only going to accelerate. But instead of doing that, Scott Bessent has a new harebrained scheme to save the bond market. And not only is it desperate, it's actually extremely risky for the entire system. He wants to get Wall Street to create a safe space for US government debt, to get major US banks to use up their balance sheet to soak up all the supply of US debt that the world economy is rejecting. At this point, we can see that Bessent has forgotten he was ever hedge fund manager. He's now officially the salesman for the Trump White House. So Bessent's plan is rather simple. He wants to deregulate Wall Street and change their leverage ratio. Simply put, that will allow the big banks to buy even more US debt. He calls this the creation of a new buyer of treasury bonds, one that is more durable and will buy whatever Bessent sells whenever there's an auction. But he must be joking. The first 6 months of the 2025 fiscal year saw an insane deficit of $1.3 trillion. That's the second highest ever since 2021 when we just came out of the pandemic. Despite the talk of deficit reduction, the national credit card is still swiping away like no tomorrow. How can US banks absorb this supply? And if the tariff war continues to get out of hand, foreign buyers will leave the time bomb with US banks. It's good to remind ourselves of how much treasuries the world actually holds, and these are long dated bonds that affect the real US economy should yields spike higher. Just take Japan and China for example. China owns 760 billion, while Japan owns nearly 1.1 trillion. Should the tariff war continue, there really isn't a need for either of them to continue buying US bonds. China obviously doesn't want to fund their own containment, so that option is out. Japan also doesn't want to weaken their yen, plus they will be trading less with the US. The biggest buyers are out, and the rest of the world will also follow suit. Bessent's plan is to get banks to fill in the gaps for this shortfall. He wants the banks to load up and keep clipping coupons from the bond yields and hold them for 10 to 30 years until maturity. But no bank in their right mind will do that in this crazy environment. The only way to get banks to buy treasuries like no tomorrow is in an environment where interest rates are expected to fall. Lower rates means higher bond values, but what do we have today? Crazy trade policy and US-China trade tensions that threatens to spike yields to the moon. And here's how uncoordinated the White House is. They can't decide if there's no exemptions or if exemptions really do exist. They don't know whether they're coming or they're going.
When the tariff rate went up to the full rate of 125 on top of the 20, it was necessary to publish a more detailed list from Customs and Border Protection explaining the rates and how they're applied. There are no exemptions. Everyone pays at least the 20%, and these particular components are being put through a separate process controlled by the Department of Commerce, which is the 232. So this is a sophisticated, elegant, detailed plan to deal with Chinese economic aggression against the United States.
And with this kind of disorder, we can forget about US banks who are still commercial entities from backing Bessent's plan. And let's not forget what happened in 2023. If US banks today start buying long-term bonds and demand suddenly crashes, the end result will be disastrous. Bond values would drop and banks that hold a lot of those bonds like SVB would go insolvent. But what does it tell you is the level of desperation that's going around the White House. And Bessent knows this. He was a manager of a hedge fund before. So this is very elementary to him. Which brings us to who will be forced to rescue the bond market. And you probably guessed it, it would be the Federal Reserve. According to Europe's largest asset manager, the Fed will step in if the situation continues to break down. If the 10-year yield continues to rise past the 5% mark, then all bets are off. Amundi believes the Fed will launch a full-scale bond buying should things get crazy enough in the bond market. In other words, we could see another QE money printing event in 2025. Now, will that happen? Once again, it depends on how much confidence is lost in the US economy. And by all measures, we should be getting a recession this year. Should Trump still escalate the trade war in the middle of that, then he could trigger another exodus of money out of the US debt markets. Then we could see yields easily hit 5% and maybe even trigger Powell to do QE. Now that isn't impossible. The Federal Reserve's hidden mandate is to prevent a total collapse of the system. So they will simply nationalize the debt like Japan and stuff their balance sheet full of US bonds. But that would be horrendous for the dollar and people's buying power. And this is where we must talk a bit about gold. If the Fed prints, this trend will only continue, the trend of gold prices going up. Now this should be mighty obvious for everyone. There's a clear reason why the price of gold has been rising, especially so in 2025. And China's central bank buying is just one factor. If you look carefully, it doesn't matter whether the dollar is up or whether the dollar is down. Gold demand keeps driving the price higher. And with the recent plunge in the dollar, it just sent the price above $3,200 an ounce. A higher gold price signals more than just uncertainty. It signals the breakdown of the current world order. The US dollar and Treasury market is losing trust like never before. It's so crazy that even Goldman expects gold to hit near $4,000 by the middle of next year, 2026, and by the end of 2025, their target is around $3,700. Now, will this happen? Well, if things continue to melt down, this is definitely a big possibility. Goldman sees a 45% chance of a recession, and for reference, JP Morgan's odds are at 60%. And if it does happen, we could see more investors pile into gold investments, and that could lift prices to over $3,800. And that gold buying will be led by the Chinese. During the last 2 weeks, we saw a phenomenal amount of buying from China. The chart just went vertical and it could go even higher. There are no limits anymore. Investors there just don't trust dollar assets and the government is telling them to buy gold. So what do you expect? We can all forecast this theme to continue even if Trump U-turns. If we need any more confirmation that things are still bleak, well, Bank of America has an urgent message for everyone. They are bringing in the gloom, they are bringing in the doom. And in their latest warning, it's time to sell into S&P rallies until the trade war is gone, that the US stock market is still fundamentally weak and a further collapse might be on the cards, it might be imminent. So how bearish is the bank? At least this time, they gave us a price target to really anchor our expectations. the index could continue falling down to 4,800 points, which would be a good time to go long for a shallow recession. But a follow-up statement is very concerning here. Investors are afraid of a collapse in earnings, and that could send the S&P crashing down to 4,000. And truth be told, we are all living day to day. Everything from bond yields to stock prices are controlled by one man and his team. And that's Donald Trump, Scott Bessent, Navarro, and Lutnick. This is your dream team. But after what we have seen over the last month, things aren't exactly encouraging. Trade policy is very haphazard. The White House doesn't know whether they are coming or going. And remember what drives stock prices? For the US market, it's the narrative of exceptionalism plus company earnings. Well, the narrative is starting to unwind, so stock multiples could come crashing down. However, on the earnings side, major banks are cutting their estimates. And should it really be a surprise here? US consumers are tapped out, and some of the tariffs started in March. Now, Citigroup has given a slew of profit downgrades to US companies, the worst in 3 years. At Morgan Stanley, they have also downgraded earnings per share of the S&P from $271 to $257, an 8% drop. And as earnings continue to crash, plus investors moving away from US equities, prices could fall much steeper than we think. This might not be our garden variety recession or correction. And can the White House reverse this? At this point, a recession is baked into the cake, but reversing the trade war is the only way to make it less painful and shorten the length of the recession. However, even that isn't a guarantee. Everything in the US markets today is dislocated. Reality and fundamentals, they are a thing of the past. And if we observe the financial conditions in the US, we are seeing big warning signs blaring in front of us. The amount of money available today has fallen back to the 2020 levels just before the big plunge. In other words, the availability of and the cost of financing have worsened. There's less money around to borrow, and the cost of borrowing that money is getting much more expensive. It's a big reason why earnings estimates are under pressure and why stock prices are caught in this limbo pattern. Everyone is bracing for impact. But more importantly, trying to get banks to buy US bonds won't solve the problem. It'll just trap the US into a Japan-like situation where there's no escape. Today, 33% of total US debt is held by foreign investors. This includes central banks and other buyers outside the US. The domestic financial sector accounts for 31%. Imagine the insanity if over 50% of total outstanding debt is held by US financial institutions. All it takes is for another interest rate shock to bring down the entire system. Now, Bessent is still denying reality about the dollar and the Treasury meltdown. However, the panic can be visibly seen on his face when asked directly about the reserve currency.
Concerned at this moment about the U.S. dollar or the U.S. Treasury losing safe haven asset?
No, look,
we're still a global reserve currency.
We are still a global reserve currency. We have a strong dollar policy. The dollar can go up and down. If you go and look back at President Trump's first term, I don't remember the exact number, but the dollar in 2017 went down, I can't remember, 7, 8, 9%, and then once the tax bill was done, took off for the remainder of his term.
The dollar today is still weak and swap spreads are collapsing. And if Wall Street buys all these bonds and it's time to sell, there'll be no one on the other side. They'll be there to buy. All their balance sheets would melt faster than Swiss cheese in a hot oven. But let me know what you think. Will the banks really listen to Bessent and buy all those bonds? And is the US economy still in the danger zone? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.